Today, on our prep for the Series 6 exam, we are diving into one of the most heavily tested topics, variable annuities, specifically focusing on their structure and the two distinct phases every candidate must know inside and out. A variable annuity is a unique financial product because it's a hybrid. It's an insurance product at its core, regulated by state insurance commissioners, but it also has securities features, which is why it falls under SEC and FINRA regulation and requires a securities license to sell. The insurance company offers it, providing a promise of income payments and a death benefit. The securities aspect comes from the fact that the contract owner's money is invested in a separate account, which is essentially a portfolio of sub-accounts that look and act just like mutual funds. This means the investment risk is on the owner, not the insurance company, leading to the potential for higher returns but also the risk of loss. The life of a variable annuity is split into two critical stages, the accumulation phase and the annuitization phase. Let's start with the accumulation phase. Think of this as the pay-in or savings period. During this time, you are contributing money, either in a lump sum or through periodic payments. With each payment, you are purchasing what are called accumulation units. The number of accumulation units you own will increase with each new investment you make. However, the price you pay for each unit, known as the net asset value or NAV of the unit, fluctuates daily based on the performance of the underlying investments in the separate account. A key feature here is tax-deferred growth. You don't pay any taxes on the earnings until you start taking money out. Another critical element, and a frequent exam question, is the death benefit. If the owner dies during the accumulation phase, their beneficiary typically receives the greater of either the total premiums paid or the current market value of the account. Now, let's shift to the second stage, the annuitization phase. This is the payout period. When you decide to start receiving income, you annuitize the contract. At this point, your accumulation units, which you've been buying for years, are exchanged for a fixed number of annuity units. This number of annuity units will never change for the rest of the contract. The calculation for how many annuity units you get is based on factors like your account's value, your age, your gender, and the specific payout option you select. Once annuitized, you start receiving payments. While your number of annuity units is fixed, the dollar amount of your payment is not. It varies each month. This is because the payment amount is based on the fluctuating value of the fixed number of annuity units you own. This is where a crucial concept for the exam comes in, the assumed interest rate, or AIR. The AIR is a benchmark rate of return, say 4%, that the insurance company uses to calculate your very first annuity payment. For all subsequent payments, the actual performance of the separate account is compared to this AIR. If the actual return is greater than the AIR, your next payment will increase. If the actual return is less than the AIR, your next payment will decrease. And if the actual return is exactly equal to the AIR, the payment stays the same. The exam loves to test this relationship. Here's a simple way to remember the distinction between the phases and the AIR. For the phases, remember, you accumulate during your active saving years, and you get your annuity allowance in retirement. For the AIR, think of this phrase: above the AIR, your payment goes up in the air. This shortcut helps you quickly answer those tricky questions about how monthly income changes. Common traps on the exam include confusing the fluctuating number of accumulation units during the pay-in phase with the fixed number of annuity units in the payout phase, and forgetting that the death benefit is a feature of the accumulation phase only. Master these two phases and the AIR, and you'll be well prepared for a significant portion of the variable annuity questions on the Series 6 exam.